Hi everyone. For this week's share and review, I'm actually going to carry on talking about investing in gold. The reason for that is it created a lot of interest, which was really good, but I've had a very good question come in that I want to address. And that question is, what would be the benefits as a Kiwi investor to buy the Smart Gold ETF, which was the one I talked about last week, versus the iShares Gold Trust? It goes on to say, since I see the iShares has a lower expense ratio, and they're asking, does the Smart Shares trade in New Zealand? So is it hedged? So first of all, we'll explain the differences. So the Smart Gold ETF is traded on the New Zealand Stock Exchange. So it does have a fund charge of 0.55%. There are no dividends paid on this particular investment, and it actually does invest completely in the iShares Gold Trust, which is what this is asking me about. They were also asking, is it hedged? The answer is no. It is not hedged to US dollars, but it is trading in New Zealand dollars. Okay, so that's something to really bear in mind. Now, if I look at the iShares Trust, ticker code IAU, it does have a fund charge of only 0.25%, and that's in US dollars, of course. Again, it does not pay any dividends, and because it trades in US dollars, there is potential there for the FIF rules, which stands for Foreign Investment Fund. And it's a taxation on investments that are held in international shares, excluding Australia. And it's calculated based on the value of those shares, irrespective of whether you have sold them or not during that financial year. Now, in order to get more explanation on the foreign investment funds tax rules, you will definitely need to speak to your accountant or tax advisor, because that is getting into an absolute minefield. And I am not all over tax. I have never been a tax specialist, so that is what I always used to say to my clients, is you do need to go and talk to your own tax advisor. So the things that you need to be aware of with these funds is, if you are a New Zealand investor and you've never had any experience investing globally, yet you do want to have exposure to gold, in our example, then the Smart Shares could be a good example for you. Okay, the reason being is because all the tax and everything like that on the fund will be done in New Zealand dollars. The reporting will be to New Zealand reporting standards for IRD. So it can make it really simple. Yes, in effect, you are going to be charged 0.8% on the fund charge all up, because the Gold New Zealand under the Smart funds invests into the iShares. So yes, you will be paying more, but that could be offset for the fact that you don't have to worry about the aspect of it, and like I'm talking about, the foreign investment fund rule. Now, something else that you also need to be considering when investing into either of these funds, let's just keep talking about the New Zealand one, and that is what the New Zealand dollar is doing against the US. So for this particular fund, because it's traded in New Zealand dollars, but it is exposed to US dollars, you are going to have exposure to our currency rate. So currently, the New Zealand cash rate is 3.75%. This is as at the time of recording. The US cash rate at the same time is 4.33%. So that means for every 100 New Zealand dollars, the currency difference, you're only going to receive, I should say, $56.85 US dollars for every New Zealand dollar. Now, what comes into play with these investments, especially for the New Zealand dollar one, like I was just alluding to, is our cash rate. Now, because New Zealand is a very small market compared to the US market, then in all honesty, if you're only going to get 3.75% on your money in New Zealand, which is seen as relatively risky compared to the size of America, where you could get 4.33% in America, really ask yourself that question: why would I want to invest in New Zealand if I was an overseas investor, where I could get a better rate of return for less risk? So that's what you need to consider, because at the moment, our cash rate is under downward pressure. So that means there is potential under the next few official cash rate reviews for our cash rate to drop even further. Now, there is also noise for the Federal Reserve to drop their cash rate. Now, if they drop their cash rates, and so do we, however, their cash rate is still higher than ours, then that is basically going to keep downward pressure on our cross rate. So like I said, you're getting about 56 American dollars for every 100 New Zealand. It could hang around that sort of figure. I mean, I'm not giving forward projections or anything like that. But what I am saying is that it could fall further, or it could hang around that area. Now, the other thing that we need to think about is if our cash rate falls and the US hold their cash rate, then highly likely you will see more pressure on the New Zealand dollar. So our New Zealand dollar will fall even further. Okay, so that can be good if you're actually holding the investment, and it comes time to obviously bring it back to New Zealand dollars, because you're going to be receiving more, because you're going to be making a gain, hopefully on the investment, but also on the cash rate difference is what I'm trying to say. So that is something to bear in mind. Now, if, for example, we go the other way and America starts increasing their cash rates, probably unlikely at this stage, but if they start increasing their cash rates, then that will also have a negative effect on our currency. So it will drive our currency down, which does make obviously the return on your investment better. But if it goes the other way and New Zealand start rising their cash rates, and suddenly we have a stronger cash rate versus the American cash rate, then that will make our dollar appreciate. So in other words, instead of getting $56 for every 100 New Zealand dollars, it may go, I mean, I have seen it around $64. I think it even got up to about 68 some time ago. So then that would be a negative impact on your investment. Okay, so that is something to bear in mind, is the impact of our cash rates versus the either of these funds. But the thing is if you are trading in New Zealand dollars, it will just have a direct impact on the value of your fund. But if you are trading in the iShares in America, then you could get double taxed for obviously the investment, if that provides you a return, plus also the currency cross rates. And again, you do need to go and talk to your tax advisor on this. That is really, really important. Now, I'll just jump across and share my screen. So I've got up here on the screen, the candles that you can see are the ticker code for the iShares Gold Trust, being IAU. Now, the red line I have put on there is the comparison for the New Zealand gold shares. So as you can see, it does pretty much mirror it. However, the big changes that we can see, like through this period here, which was end of February this year, I have got this on a one-day chart, by the way, simply because the New Zealand Gold Trust hasn't been trading for that long. It only started last year. And you can see we had quite a divergence until it sort of caught up again around about a month later. And the reason for that will be the movement in our currency. Okay, so that is what is really driving some of these divergences here. Otherwise, it really does mirror what's happening. And to be honest, you would expect that too, simply because the New Zealand Smart Share is investing in the iShare held in America. So the only driving difference is our cross rate. Okay, so I really, really hope that has helped you. And I love the questions, so keep them coming in. Now, if you are considering investing through America, and if you don't hold a brokering account at the moment, a broker that I use a lot of is Tiger Trade. I find their system really easy to use. It's got a very good mobile app, as well as you can use it on desktop. So for those that are interested, what I can do is at the end of this recording, I will also pop in the note, the link, if you like, to Tiger Trade. And if you do click on my link, it could mean if you do open a funded account, it could mean that both you and I are given a $50 credit. Okay, so just a little disclaimer there. So I hope that's helped explain even further the intricacies of those two funds. It was an excellent question, and obviously it's really starting to get into the nuts and bolts of investing into something like gold. The other thing that you do need to consider is, because gold does not provide a dividend, again, you will need to talk to your tax agent on this, but because it doesn't pay a dividend, irrespective of which fund you go into, there may be tax implications. In other words, you may or may not be able to get around the fact that you're holding this for a long-term investment, because if you're not receiving dividends on it, then sometimes it can be quite hard to argue the fact that it's a long-term investment and you're getting it just solely for cash flow. So that's something to bear in mind, especially if you're looking to ride this current strong trend that we are seeing in gold. So I hope that's helped. Thanks for the great question. And if you've got any others, keep them coming. Thank you.